Well, now we're going to be joined on the show by our expert guest for today, and that is Shweta Jain from Investography. Shweta, thanks so much for taking the time out and joining us today. And let's kickstart this very interesting discussion that we have lined up for our viewers on penny stocks. So, tell us, Shweta, we've been hearing a lot of buzz about penny stocks, and there is a lot of misconception in the market when it comes to this particular category of stocks. People do have the premonition that they are going to become overnight millionaires if they invest in penny stocks. So help us clear the misunderstanding around penny stocks. First of all, help our viewers to understand what exactly are penny stocks and how are they different from the traditional stocks that we see.
Hi, Snehi. First of all, thank you for having me on the show. So, penny stocks, very interesting discussion and very relevant, especially for new investors who tend to think that they can become millionaires overnight. So, penny stocks are stocks that have very low value, usually lower than 10 or lower than 20. So, if you go to different brokerage houses, somebody will define it as lower than 10, somebody will define it as lower than 20. So, that's usually the kind of stock value that you're seeing there. So anybody who's looking to start investing newly thinks that, because they have low value, they must be really good and they can gain a lot when markets rise, which isn't necessarily true. So one of the things that makes penny stocks very different is that sometimes they may not even be listed on the stock exchange. There could be just traded over the counter instead of the listing requirement that is there. So their market capitalization, so to speak, may not even exist. They are highly illiquid. Of course, they are smaller in nature, and so you tend to buy more quantity. So even if you're investing, say, 1,000 rupees, 10,000 rupees, if you're investing 10,000, you get 1,000 stocks, which another large cap company, even one single share may be more than 10,000 rupees. So that is the kind of feeling that an investor gets, that I have now 1,000 shares of a particular company, right? So that's why people usually fall for something like this. One of the bigger differences is there's a lack of knowledge about the company that is there, because they don't really declare any information. They don't really share any information. They don't file with SEBI. They don't have to. So in that case, how do you get any real information about them? That is true. The company may not have any real business also, so to speak. There may be no minimum standards. It may be looking at bankruptcy, or it could be a fantastic company which is just very small. So it could be either way. So it's not really something that people can count on to make money. One of the things that I usually advise newer investors is to stick to mutual funds. And if they're looking at stocks, then look at large cap stocks, blue chip stocks, names that they recognize. That's how to start. One of the other things also of penny stock is, before I sort of diverge to a large cap and other stocks, there may be very low liquidity in penny stocks. So while you may want to sell, and even if the prices seem higher, say you'd bought it at 5 rupees and now there are people willing to buy at, say, 25 rupees or 30 rupees, but they may not buy the quantity that you have. So you may be able to offload, say, maybe 20 shares out of your 1,000 shares, for example. So then that's not really any much gain. So liquidity may be a huge deterrent as well.
Thanks so much for taking us through that. You've also covered the potential risks that are associated with investing in penny stocks. So thanks so much for that. What I want to point out to the viewers is, like Shweta mentioned, right, just because you can buy a lot of quantity and you think that if you have a bigger quantum, even a minuscule gain could be a big gain, it's also key to remember that a minuscule loss could also be a big loss. That is what Shweta also highlighted for us. So Shweta, thanks for that. But now let me ask you my next question. You did speak about large caps, but we've commonly seen, people interchange the whole concept of penny stocks and small cap stocks in their head. So help us understand the difference between what a penny stock is and what a small cap stock is, the difference between the two, and why a small cap could potentially be less riskier when you compare it with a penny stock.
So small cap companies are companies that are listed with SEBI, and the definition is a company that has a lesser than market capitalization of 5,000 crores is considered a small cap. So, most of the Indian companies, I would say about 90% of Indian companies fall under this category. The type of companies that holds a rank about 251. So other than the top 251 companies, the rest become small cap companies. So the bigger difference is that there's a lot of information available because these are listed on the stock exchange. So that is the first big difference. Second is that there will be liquidity and not as illiquid as penny stocks. These are stocks of smaller companies, but they are publicly traded on the stock exchange. So if somebody is looking at uh, investing in smaller companies, the way to go is not a penny stock. The way to go is then a small cap stock, a smaller company. But we should remember that these are still volatile. The risk factor is still there because these are smaller companies, so these are more susceptible. Returns may be quite enticing here, so people see multifold returns in small cap, but one should also remember that they could see other than if it's not a multi-bagger, they could lose their entire capital as well. The cost of investment could be that that instead of going with a larger company, with a mid cap company or a large cap company, they might end up investing here and losing that money here. So I think if you're looking at benefit of penny versus small cap, I would go with a small cap company because there's much more information. It's far more reliable information. There's more liquidity, better quality of businesses. The opportunity to increase your money is more here than a penny stock, where I think you would more determine that by luck. So I know people would want to still put in money in penny and small both. So if you're looking at money that you're okay with losing, then you look at a penny stock. But if you're looking at investment really, then I think small cap is the way to go.
Well, point taken, but let's shift focus back to penny stocks from small caps now and help us understand how can investors identify potentially promising penny stock opportunities amid the vast number of choices that are available. So now a lot of penny stocks are available. Some of them have actually done well, while some of them have not moved at all. So what are some factors that people must look at or investors must keep an eye out for? How do they evaluate a company, if it's a good company or a bad company, and then how do they select the penny stock that they want to buy?
So one of the ways that they can evaluate is the information that is there, the the results that they are sort of sharing, the information that they're sharing, the number of shares that are outstanding in the market. That will also help them see how liquid or illiquid this business is. What kind of business prospects does this company have? What is the background of the founders or the management of the company? Because that also is a huge factor when it comes to smaller businesses, that what kind of management is there. Is this family run? Is there good track history of the founders with businesses, or is there shady businesses? Who the auditors are. I think one of the other things that investors can look out for is audited results and who the auditors are. That is something that they can definitely look at, because of course not every penny company or any penny stocks are bad. There will be good and bad in the lot. It's just that in this lot there may be more bad than good, and to identify the good you may have to do stocks. Are these new in the business? They have a smaller sort of track record? Are they looking at listing in the future? What kind of information are they sharing? Not just the quantity, what quality of information are they sharing? All of that becomes really interesting.
I understand what you mean, and thanks so much for taking us through that. With that, you stay on with us on the show because we'll slip into a very short break. On the other end, when we come back, we'll also be talking about some viewer queries and their mutual fund portfolios and how they should be constructing a good portfolio going ahead. And Shweta will be here to help us guide on all of those lines as well. So, while you stay tuned, we'll be right back after this short break.